Starting your lending business with little or no capital. Imagine walking into a crowded Lagos market on a Monday morning. Around you, traders are already setting up their stalls. A woman selling fabric needs 150 to restock her goods before the weekend rush. In the same way, we also have a young man with a repair kiosk, a phone repair kiosk that needs 80,000 to buy phone parts. We also have a caterer that needs 200 upfront for a wedding contract. She just secured. All these three have one thing in common. They all have customers waiting. What none of them have is capital. Now, let's walk 2 streets away. We have a civil servant, a retired civil servant that has 200 million sitting in a savings account, earning 3 million or there so per annum. We also have a disparate returnee who has $10,000 she doesn't know what to do with. Let's look at it from the cooperative aspect. We have a cooperative society in Ikeja or somewhere in Lagos. Let's say that has pulled a total value of 50 million from 300 customers, and they are debating how to deploy it effectively. This is Nigerian credit paradox. Using other people's money through financial intermediary model works very, very well. We'll be looking at a practical blueprint for entrepreneurs to scale their lending businesses. You do not need a banking license to tap into this market. You do not need your own millions to tap into this market. What you need is the right knowledge, the right structure, and the right relationship. This video will give you all three. The model we'll be looking at is built on the principle as old as banking itself. You become the trusted bridge between people who have money, which is a surplus unit, and the people who need money, the deficit unit. The modern version of this is a technology called peer-to-peer, P2P lending. Nigeria's financial landscape is defined by deep structural tension. Millions of individuals and businesses desperately need credit. While a significant pool of idle capital exists in savings, cooperative fund, and personal wealth funds, yet former bank serves less than 5% of this credit demand. This video is your practical real-life blueprint to position yourself as a practical bridge between these two forces, the surplus and the deficit, without investing much of your own capital. Drawing on the principles of financial intermediation and the explosive growth of peer-to-peer lending globally, this guide walks you through the very stage and how to legally structure your lending entity, how to raise capital from investors, how to screen borrowers, how to price your loan, how to manage default, all with zero or minimal startup capital from your personal funds. Let's use the real Nigerian case studies. Let's say from Abuja cooperative lender to Lagos based branch fintech entrepreneurs, where we are woven throughout to make every concept tangible and immediately actionable. So whether you're an unemployed graduate, a side hustling professional, or an aspiring fintech founder, this video shows you exactly how to do that. Every concept in this video is grounded in real Nigerian principles, okay? So it can be deployed in other countries too, but we are using Nigeria as a case study so that you understand how it works here first. So every strategy has been tested in real communities all over Nigeria, okay? So let's first of all, before we dive in, let's look at what you understand by financial intermediation. Financial intermediation is the process by which one party, an intermediary, channel funds from those who have excess money, which are the savers, to those who need money, which are the borrowers, the deficit unit. Banks are classical financial intermediaries, okay? So they take deposit and give out loans. But banks are not the only intermediary, and in many ways, they are not the best for everyday banking entrepreneur. I'm not telling you banks are not the best, but I'm telling you when it comes to serving the retail market, they don't quite reach, the outreach is not there yet, okay? But this is a guide for all entrepreneurs, those are in the business, those that wants to go into the business, to know the kind of model that will be, that will be okay for you. So let me give you an example of how it works for banks. A bank collects deposit from, let's say, 1,000 of customers, let's say at 4% per annum, let's say. Then less that money out at 23 to 30% per annum to business and individuals. The spread between 4% and 22% is the bank gross margin, out of which it pays its staff maintain branches, service technology, and generate profit. Okay, but before you understand how it works fully, you need to understand the players here. We have the depositor, which is the surplus unit. We have the bank, which act as the intermediary. We have the borrower, which is the deficit unit. They need much of the money. Then you have the bank spread, which we're talking about the profit. So you need to understand the role of all those three. Then you need to understand where what your role is. You act as an intermediary. Note, you don't just act as an intermediary. There are things you should do. So when we say you are going to be starting with little or no funds, it's exclusive of the startup cost, maybe registration and the rest of it. But when it comes to peer-to-peer, we're going to teach you how not to use much of your money or how not to use your money at all. So I just want you to stay tuned and follow me. I did remember I said you don't need a commercial bank. If I say you don't need a banking license, it doesn't mean you don't need it, but you don't need a commercial banking license. So the Nigerian banking laws require commercial bank to hold billions in minimum capital and comply with sensitive CBN regulations. Okay, so but there are several entire legal structures that allow you to, intermediate funds at a smaller scale without a banking license. That's what I mean by you don't need to have a normal commercial banking license. So this includes cooperative societies, which are regulated under the Cooperative Society Act. We have the microfinance businesses, which are non-deposit taking models. We have the money lending businesses, which is regulated at state levels. You also have the P2P lending platforms, which is operating under CBN's 2002 regulatory framework for digital lending. And that is what we'll be discussing today. We also have investment clubs and informal pooling arrangements where funds are being pooled and, it's being rotated at the end of it. These monies are being used. I want to give you a true life story. This is a true life story. Let me use Emeka Obi, for example. Okay. So Emeka Obi is a 28-year-old graduate from Enugu State. He registered a money lending business under the Enugu State money lending law in 2021. Now listen, he raised 3 million from five friends and family members at 15% per annum. Remind, this is not his money. He then lent this money to market traders at 8% per month. Okay, that's approximately 96% per annum effectively. So after paying his investors and covering operational costs, he cleared over 800,000 net profit in his first year without using a single dime of his own personal savings. Are you getting the logic? Now, it's one thing for you to try this model, and it's another thing for you to approach it the way it ought to be approached. We're going to be looking at three things that will form the pillars of successful intermediation. Number one is trust. Surplus units, investors must trust you to safeguard their funds and return their capital. If you have had your image tainted and dented in the public, it will be difficult for people to trust you. So if you're going to be setting a business up as a financial intermediary person, you must have gained and garnered enough trust. You must have information advantage, which means you must know your borrowers better than any formal institution. This is the edge over so many banks. A lot of people walk into bank and they say they need funds. They don't have access to these funds. So you have to have good information where the market is, where to get them. You must understand risk management. You must have system to screen borrowers, monitor loans, and recover funds when things go wrong. This is where the MIS come in. This is where the technology comes in because it's very, very key. Yes, can you run intermediary without digital infrastructure? Yes, but I tell you, it will be much more easy for you if you get one. So these three pillars, form the entire architecture of this video. So each chapter builds on one more than the other. So master this, and you have the foundation of a lasting learning enterprise. Let us look at the deficit and surplus unit framework. Okay, so in economic theory, every economic sector is either surplus or deficit. It's always that way. There's nothing you can do about it. Okay, so a deficit unit, which is one who needs more funds than they currently possess to pursue economic activities, are always more than the surplus unit. So if we look at the Nigerian context, this category takes on vivid approach, to trying to balance how the deficit unit would match up with the surplus unit. Okay, so let me use Nigeria as a case study, just like I've said. So let's look at the surplus unit in Nigeria. I'm already giving you the tips so that you know where to look at. Where are the surplus units? And I'll explain how you can get funds from them too. So example of widespread surplus unit that we have, they include cooperative society. Now, the good thing in Nigeria is we have over 60,000 registered, more than 60,000, I can say, now registered cooperatives in Nigeria. They collectively hold billions in members' contribution. Most are deployed in low-yield savings or in government bonds. Now, if you are a member of a cooperative society, you have idle funds just waiting for you to tap onto. Cooperative are ready to give you money because they always have money at their disposal. Remember, when you get this money and you are investing it in the right way, you are going to get yield. I'm giving you one way you can invest without your money. Then we also have Ajo Esusu groups. These are rotating savings group that are much and across all the Nigerian states. A 20% contributing, let's say 50,000 monthly, automatically generates a 1 million per circle available for lending. So if you are the first, the second, or the third to get a hold on your Ajo or your Esusu or whatever it's called in every other country, you've already gotten an idle funds to work with. Isn't that wise? Now, if you are Nigeria in diaspora, let's say Nigeria received over 20 billion in diaspora remittances let's just say in 2023 alone, not talk of 24, 25, 26. But in 2026, you can imagine how much that has gone into now. So a significant portion sits idle or in low yield account. What are we doing with this money? Let's look at it from the salary earners approach. In your work, in your place of work, you can, form a rotating scheme that will make you contribute a certain amount, even without going down to the Susu group. You have narrowed it down to just staffs. It could be members of your family. The bottom line is you just have to create in a way that works out for you. So now let's look at it from high net worth individuals. We have business owners and investors seeking return, above fixed deposit rate anyway. Let's say it could be more than as much as 10 to 15%. So these people want to invest. They are just looking for the right business to invest. That's why digital lending all over the world, the funding is not just here. It's getting big. Let's look at, some might say, no, religious bodies, they need money. But I can tell you, we have a lot of religious bodies that have idle funds sitting in their coffers. Is it the church? Is it the mosque? And if they are wise enough to invest, they make good. We have some religious institutions that have invested in digital infrastructures, lending, and they are making it real good. Okay, let me just say, I'm not going to call her name. Let me just say, Mama B runs a 30-woman Ajo group, somewhere in Lagos. Each member contributes 100,000 monthly. A total automatically is a 3 million. So traditionally, this rotates among members. So Mrs. A sharp 32-year-old, approached Mama B, with a proposal. Instead of rotating the full pot to one person, allow her to manage it, as lending for traders in the market somewhere in Lagos. Then she will generate a 20% annual return to all members, double what any bank was offering. The members agreed. So A deployed the 3 million to 15 market traders at 10% per annum. After 3 months, she had collected enough to pay 20% annual return and keep a substantial management fee. Wow. She has started lending business with 0 naira of her own money. You just have to think outside the box. You just have to be smart. You just have to be quick. You just have to be focused. Let us look at who the deficits are. The deficits are even more numerous. They include micro entrepreneurs and traders. We have SME owners. We have salary workers. We have farmers. We have students and young professionals. We have artisan and skilled trades people. We just have them in different skills. There's a program in Nigeria called Nail Fund. I know somebody will say, what do students want to do with money, and how do students why do students need money, and how will students pay the loan they have? There's a program in Nigeria called NEL Fund. The loan is specifically tailored to students entrepreneurs, students that are still in school, that are about to finish, but they have acumen for business, which means it's not just enough for you to say you're a student. You can be a student and be a made rich student. So now let's look at your role as an intermediary. Your job is to sit in the middle of this equation with precise intelligence about both sides. Okay, so you know Mama C, the fabric trader, sells kind of goods. You know Mr. A corporate society that has tons of millions sitting idle in their coffers. You know, you can create a match, structure the transaction, manage the risk, and end the spread. This is your business model. If you got what I said, then you get it. But if you don't, then just forget it. I'm just going to say it once. If you didn't hear what I said, I'll advise you to replay what I just said now. Before I forget, I will advise you, click on the subscription button. There are lots and lots of videos that we share that are educative. Follow me, subscribe, and make sure you stick to this channel, Microfinance Arena. The Nigerian specific advantage you have is that you have quite a lot of surplus units and deposit units. The problem is they don't know where to get in touch with each other. This social capital is worth millions, and no bank can replace its scale, no matter how big bank is. I know every bank has their customer, but believe me, this is an eye-opener for everybody that wants to make sure they make something for themselves. Let's look at what the peer-to-peer lending, model is, and let's explain it in the bits that we can for those that are novice in this field. A peer-to-peer lending is a method of debt financing that enables individuals to borrow and lend money to each other, typically through an online platform or a structured arrangement, without going through traditional financial institution as a principal risk taker. The platform or the intermediary, connect lenders with borrowers. They facilitate transaction, they manage repayment, they make schedules, they charge fees for services. They just make sure it works, and their main purpose is to make sure there is flow of funds. Okay, if we say flow of funds, what do we mean? Surplus unit, deposit funds probably into a platform, and you as the intermediary, you screen borrower, you structure these loans, you look at deficit unit, which are the borrowers. Their main responsibility is to make sure that they repay their principal and interest. You distribute returns to investors, retain management fee, you make some money, and everybody is smiling. Okay, without mentioning some models that are working in Nigeria, we already know them. We've seen Fair Money. We've seen how they started. They started as a digital lender, but now incorporate large investor side components. Over 2 million borrowers. Let's look at Carbon. Which is, I think, formerly Pay Later. Yeah, that's a company there. Let's look at Kia. Let's look at Rem Money. Let's look at Lydia. And we have one, not a Nigerian, Kiva. They all started with this model, and they are doing perfectly fine. This company started small. I'm going to give you the story of how Carbon started. Carbon's founder, they started initially from their own pockets to prove the concept. Then they raised investors' capital. You can replicate this model at a community or city level without the technology infrastructure cost. You can start with WhatsApp, you can start with Google Form, you can start with basic accounting software. So remember, when we say you can start with little or no company, it does not include setting up infrastructure or registration, which is a key thing that you need to know and do first. There are 3 versions of peer-to-peer lending you can run. You can run one that has no tech requirement, low scale. It's quite detailed. I'm not going to go into that. That's not the focus of this video for today, but it's quite deep. Maybe on request I can do a later video on that. But that one requires no tech structure. You act as a trusted intermediary in your community. Investors give you money. You lend it to vetted borrowers. Everything is managed through paper arrangement, bank transfer, and personal relationship. Ideal starting point. Then you have, the semi-structured, which is, basic tech. You set up a basic digital presence. Let's say a WhatsApp business account, a simple Google form, for loan application, a spreadsheet tracking system. You begin to formalize process. This allows you to serve, 50 to 20 borrowers at once. Then you have the version C platform, which is the P2P, which is a full digital version. You build or license a lending platform like a conventional loan app or white label platform. Um, investors can register, fund wallet, and choose which loan category to invest in. You become the operator and earn, platform fees, management fees, and origination fees. This is the fintech part that you can really work on to make sure you make it as a P2P lender. We want to focus more on on um, on the full digital platform. So let's just dive a little bit about the A and the B, which is starting from the no tech requirements and the basic tech requirement. Starting to P2P lending does not require much capital, which I repeat again, but I can tell you, you must put structures in place and this will cost some little bit of funds. So operating without the legal structures exposes you to regulatory risk and erodes investors' trust. So and one thing you should know is Nigeria has several legal pathways that allows you to operate a lending business without a bank license. So the right choice depends on your skill, your target, your capital raising strategy. Number one thing you must have is you must have a business name. It could be a sole proprietor, it could be a business, it doesn't have to be a limited liability company. Okay, so you start as small, but you must register with the Corporate um, Affairs Commission of Nigeria. And if you know you want to make it a little bit more deep, you register a limited company. Okay, the other thing you must do, try and get a money lender's license from the state level. If you are not, you are at risk. You cannot sue a customer that is refusing to pay. So what this does is that it puts you in a position where you have government backing if you have a defaulter. Okay, then you must have a business registration, just like I've said, and a money lender's license. If you are going to run it through a cooperative society, which means you must, after your corporate affairs certificate registration, you must also register with Association of Cooperative Societies. Okay, then as of 2022, CBN introduced a digital lending framework. If you are going to be digitalized, you must be registered with CBN issue regulatory. You must comply with CBN regulatory framework for operation of digital lending in Nigeria, which is from 2022. It is key requirement for fintech or digital lender. It includes incorporation of CSC, compliance with consumer protection guidelines, no harassment of borrowers, because it's been a very big issues with lenders. We have a lot of people that are, a lot of this lending platform, but they are not just making their adequate repayment as at when due. So if you're a solo starter or community lending base, you can start with a business name. But once you are growing your operations, please make sure you are a registered limited business. And if you want more depth and breadth of the business, you can, sign up for a cooperative society. It depends on, what you want to do. Now let's look at raising capital, which I know that is always everybody wants to hear. In this part, raising money from other people to power your lending business is not difficult, but it can be difficult. It requires clear value proposition, trust. Like I said, that's why I said the first three things we mentioned is based on this promise, and with the first one is trust. Then we'll be looking at infrastructure. Then we'll be looking at professional documentation. So let's look at how you are going to do it. So number one, you need to have the skill to pitch to investors. So every potential investor will ask 4 questions before committing their money to you. You must have compelling answers for this. Number one, what return will I earn? They want to know. Number two, how safe is my capital? They want to know if their money is going to be coming back. Number three, how liquid is my investment? Liquidity means once I want it, how soon can I get it? What can be converted to cash so that I can have my money as easy and as quick as possible? And number four, which is supposed to be the very first question, who are you and why should I trust you? Character, track record, social proof, references, these are all key. That is the first thing that investors that you want to pitch to is going to look, it's going to be looking at. Then let's look at the source of investors' capital. Okay. Um, let's look at family and friends, which is the tier one, which is always the starting point. So that you are bringing out your money or you are getting money from family and friends. So start with people who already trust you. Okay. Um, no matter how big or small, just make sure they trust you enough for you to be able to learn. So you need to be transparent and be professional when dealing with family and friends when you need to get money from them. You know, treat this money with extreme care. Don't say because it's given to you as a gift or your mother or your father or your brother, then you treat the money with so much disrespect. Okay, so one successful circle with family money opens the door to everyone. Like I said, I started with you joining cooperative societies. You need to approach cooperative society with the idle funds, present a formal investment proposal, show your lending model, interest rate, risk control, and just show them you have good track record. You can visit high net worth individuals. I've been talked about them. They look out for returns above fixed deposit with stock. If commercial banks are given 10% per annum, then you should be able to do something better. And I can assure you, offer returns close to 20-28 per annum. And I'm sure they are sure to sign up. Religious communities, I think I did discuss that, where some of them have idle funds, some of them have actually started lending platform and microfinance institution. Some of them don't actually know, so you can also pay them a visit, give them a proposal. Maybe you might just be the next managing director. They will be appointing just like Joseph was appointed to rule Egypt after he solved a problem for them. So essentials document to raise capital professionally. You must have investment agreement, memorandum of association. You must have business registration document to show that you are registered. You must have portfolio report to show your monthly statement, loan disbursement, what you have done on day-to-day, week-to-week, month-on basis. You must have risk disclosure statement. You need to be honest about risk. You need to be sophisticated with investors, and you need to, and because they will appreciate transparency. Then you need to have personal guarantees, optional but not necessary. What personal guarantee offers is security that they know you and they can vouch for what you are doing. We'll be going deep into peer-to-peer lending. This is just the first series of peer-to-peer lending. There are a lot to discuss. There are a lot of secrets behind it. There's a lot of things that will interest you. My name is Henry Oster Onyema. Welcome to Microfinance Arena. Microfinance Arena. This program is sponsored by Leon Consulting, and I can tell you, this is just the beginning. A lot of people want to do a lot of things out there, but they don't have the basic requirement. Funds has been a problem. What we are bringing to you is solutions to make sure you proceed, you progress, you just make it. So this is an opportunity for you to grow. Like this channel, subscribe, follow us for more, and you're sure to enjoy what we'll be bringing to you next.